To this week's edition of the Self Wealth Live Technical Analysis Edition. How are you, Jason, today?
Hi, Rog. I'm good. I'm good. All good and ready to go for some more diving into charts.
Fantastic. Obviously, last week we had a bit of a breather, but look, to be honest, not much happened anyway. So I'm looking forward to seeing where we're at after a couple of weeks off our live session. That is. First of all, Jason, obviously you've been in the game for 30 years. I thought before we get into the really interesting disclaimer that you're going to put up, I thought I'd just quickly ask you a little bit about your trading setup. Now, if you see a picture of, I know you're not a day trader, but if you see the very cliche picture of traders out there, you might see them with 4, 5, 6, maybe even 8 monitors in front of them, looking at 30 charts on every single monitor. Maybe you can let us know a little bit about your trading setup. How do you approach the charts, technology wise?
Yeah, look, I love the pictures I see when they do the dealing room shot where you got the guy in front of, as you say, like 6 or so screens with things going on everywhere, and I just look at that and I just see utter confusion. I don't know which screen to look at, and my setup is really straightforward. It is, I got one screen, and I click between the screens. I click from my looking at the charts over to the Self Wealth account, over to Excel or Word or my trading software, because I can only look at one thing at a time. So I don't need 6 screens on the go, because I can't be writing something and reading something and trading something all at once. So for me, I just don't need a whole lot of screens. Maybe like a couple of screens could be useful sometimes if you are particularly active in your trading and you want to be working on something, you want to glance over and see the prices moving around. But look, I think for the most part, like I like to use end of day data. So I get my signals that I need to do for the next day, and I might come back and forth to my screen a few times in the day to check how orders are progressing, or to look at some charts which are interesting. And that's why we're a little bit late today, because I was gazing at charts and lost track of the time. But yeah, I don't need six screens on the go to do that. And it's interesting. Back in my time at the bank, back in my 20s, we had our PC screen, and we'd have there'd be another monitor where we could do make prices, interbank price making with the other banks. And then there'd be a screen where we'd be able to call up the charts. So we're kind of operating off 3 screens, but we weren't looking at them all at once. So yeah, I think with everything, keep things simple. Don't get caught up in seeing some of these images you do around the internet and thinking that's what I need to do if I want to get serious about this. I need to get all these screens on the go, because you don't. You can keep it simple. And simple processes often work best.
I'm going to admit, I did go out and buy 4 monitors thinking that I was going to be an amazing day trader. And I probably haven't given up that dream just yet. But I've definitely given up all the monitors for now, because I just think I had 3 monitors. I still wasn't successful after a few years. That said, doesn't mean that it was the monitor's fault. I went back to your principle of trying to keep it simple, right? Maybe I don't need that many charts. And to be honest, I'm having more success today than what I ever had when I had the 4 monitors, right? So for the purposes of this video, I'll blame the monitors. Yes, I was guilty of thinking that we need to have 3 or 4 monitors, just like all the other cliche images out there, right? So
it's interesting. In the original Market Wizards book, which is a great book for anyone who hasn't read it, who's interested in markets, interviews with all these top traders of the day, and it's all still very, very relevant now, even though the book was written would have been written in the late 1980s. And there's one guy in there, a guy called Ed Seykota. So he's one of my mentors through print. So I don't know the guy, but I've read all about him, his processes and techniques, and I've adopted a lot of those myself. He makes in the interview, he says, the interviewer, Jack Swagger, he goes, Ed, you don't have a screen on your desk. how do you know what's going on in the market? And Ed says, I don't have a screen because if you have a screen, you end up looking at it all day long. He said having a screen is like having a poker machine or something on your desk, and you just end up playing it all day long, feeding it all day long, putting on trades that you don't need to make. So being a little bit detached from the intraday price action can actually be a benefit, because you're not looking for trades that you really shouldn't be looking for. Just get your end-of-day data, know what you need to do, monitor things through the day if need be, and then go away and do other things. Let the market do what it does.
Yeah, and of course, look, if that's your thing, then certainly do it. I'd love to hear in the comments actually how many screens everyone has, right? Because it's just if it works for you, it works for you as well, right? There's no right or wrong, right? It's just what you believe.
Absolutely.
Right. So, all right. Look, welcome to everyone else. We missed everyone last week as well. Obviously, these sessions have become quite good for us, as well as I'm sure our viewers. So thanks for coming once again, everyone. Before we get into the regular proceedings, Jason, did you want to go through the disclaimer?
Yeah, and just one last point on this. Me saying I only have one screen, it's not to make anyone feel they're doing the wrong thing if they do have 4 screens. There's nothing, as you say, Roger, there's nothing wrong with doing it. It's just more to point out to those who think, well, I have to do that. If I'm serious, that's what I need to do. There's nothing wrong with doing it if you like to operate that way.
Exactly.
But if you do like operating that way, look, that's fine too, because there's no single way to make money in the markets. There's no single process. There's no single setup. You find what works for you, but don't think you have to overcomplicate it or go to a whole internet-like looking setup if you don't want to, because you don't need to.
I'm pretty sure you told me once you had one screen in every room of your house, didn't you, Jason? Is that right? You don't have them all together. You have just one in every room of the house. Is that right? Just so you can monitor as you go.
Yeah.
Right.
So the kids' YouTube set up one place, and the sports channel on another one. Yeah, different screens, but not all showing markets.
Oh, fair enough.
So, disclaimer, everything today, general commentary only, no personal advice is given here. That's all we do. We're just talking generally about markets, and the disclaimer we put up each week. I'm not part of Self-Wealth. My business is Motion Trader. So you can see the disclaimer for that up the top, and outlines the general advice, licensing details, important things like that. Self-Wealth disclaimer is below that. So have a look at that. And always remember, everything is general only, not tailored specifically to you.
Exactly. Thanks, Jason. All right. So today we're going to go through the markets, obviously, the 3 main ones that we go through each week and that are available on the Self-Wealth platform. And then we're going to go through our topic, and it sort of come out of one of the viewer questions, actually. And we've covered this in a previous show, actually, but we thought it'd be a good time to go over it again, because we kind of are starting to get into this sort of ranging market again, right? So we're going to get onto that, and then we'll get onto everyone's questions as well, as best as we can with the time that we have. All right. So, Jason, without further ado, let me just see if there's no questions relating to our monitors. Just see the monitor set up right here. 2, yep. 1, 3. No one's gone to the 4 yet, so I'm the only crazy person that's done the 4 when I first started. All right. So, Jason, how's the ASX looking at the moment?
Okay. Well, let's jump over to the charts. And that is not the ASX. We will get to that one in a minute. This is the ASX 200 here. I'm glad that other one's not the ASX 200. So this has been a seesawing couple of weeks, really. What we've had for the ASX 200, sold off heavily a couple of weeks ago. Then we had a nice rebound in the mid last week. Then it's come off again, and the last couple of days we're getting another rebound. So lots of moving about, but it's really still where it is, where it was a month ago. Really, a lot of back and forth for not really much net movement. I'm continuing to treat this as a pullback within a bullish trend, because so far I just don't think the evidence for a larger decline is currently there. Now, of course, that could develop, but at the moment, that's not what I'm seeing. So I'm working the basis that the underlying trend remains up. But I think whilst that underlying trend is up, I still think that we're going to see some sort of a pause in the trend and some consolidation. And my take on this is the ASX 200 really could be in for several months of consolidation. I think that's a reasonable possibility. Of course, it might not happen, but it wouldn't surprise me if we get several months of back and forth and just messy price action. And if you look at the pullback so far, to where the market currently is, it severs this series of rising lows that had been formed pretty much since the low back in October last year. So that's a bit of technical damage which has been done. Now, that doesn't mean that it's all downside from here, but it just breaks that near-term momentum which we had moving to the upside. And also just looking at the extent of the decline. So that's a 5.5% pullback from the top to where prices got to on Friday a couple of weeks ago. So I think this is more than just a routine, maybe 1, 2, or 3 week pullback like these pullbacks we were seeing earlier in the year. I think it's a degree or two higher than that, and that means, from my perspective, that it takes longer to work through. So I think this is maybe a correction of the whole advance. So from that October low, 18% in 5 months. It was a big run, and I think that's what we're currently consolidating. I think that probably takes time to work through. Keep an eye on these moving averages. They're just starting to roll over at the moment, and that doesn't mean that everything automatically goes to a bearish situation, but I think it's just another sign that the momentum's out of the market at the moment, and it's time for consolidation. And what I want to do now, I just want to see how prices behave around these moving averages. So it is holding around the 100-day average at the moment. This would be a nice place to get some sort of bounce back up towards the midpoint of the decline, or maybe a bit higher. I don't know. We just got to see whether that plays out. What I wouldn't like to see here is for the market to sort of fall again and then start to quietly trade sideways below moving averages, which are then starting to roll over and trend lower. That would be a vulnerability, and then that could potentially set the stage for another decline. But if that were to happen, I think that would still take a few weeks to play itself out. So it's just something to keep in mind at the moment, that we don't want to see the market decline and then just sit below declining moving averages. That's a vulnerable market. But that's not where we are just yet. We've been talking about this for a while now, Rog. My focus is staying with stocks which have done well. I don't want to sell profitable positions unless they break down. So what we've seen in the ASX 200, for me, that's not a reason to go out and start selling all my best stocks. I want to hold them unless I've got a good reason to sell them. And at the moment, I haven't had a good reason to sell any of my top performers in the last 2-3 weeks. That said, I'm not hesitating to cut stocks that hit their exit point. So if a stock's struggling and it's hitting its exit, or it hasn't been able to gain momentum after buying it a little while back, I'll kick it out of the portfolio. So managing risk is always a priority. But at the same time, I think we also need to be able to have strategies that help us see off moderate volatility. And I think that's essential if we're going to stay on trends over time. So as we often talk about, it's those wide trailing stops never get you out at the high, but they can help you stay in those good stocks and see off these pullbacks. If this happens to be just a pullback, it helps you see those pullbacks off along the way.
Yeah, I'm going to stick on this chart for a little bit, because I think I'm going to use my chart eye a little bit, and there's a couple of conflicting conflicting pictures to me in the last couple of weeks, let's say 3 weeks, 4 weeks. So first of all, and you can tell me if I'm right or wrong on what you see there, Jason, but this is the pullback that's sort of broken the last higher low, right?
Yep.
So I'm sort of seeing maybe a head and shoulders, bearish sort of pattern of head and shoulders up the top there. But then there's a conflicting of the last week of two sort of pin bars that have just formed there that could push the market up a little bit before the head and shoulder continues down. So I'm not sure. You see that?
Yeah, the head and like, I think, would you be this area here, Rog, the last couple of weeks, is that what you're looking at for a shoulder?
That's right. So that would be your right shoulder, which has now become lower than your previous left.
Yeah. So the way you'd need to draw that in would be to draw a neckline like that. Yeah. So you got this downward neckline, which is pretty messy. So when you think like, how does that neckline trigger? The market's then got to fall and break below there. So that becomes your breakout point, and then you do your projection lower, and you end up with something down here. It's like, of course, the market could take that form, but for me, the better sort of head and shoulder patterns are when you get a neckline more like that. And of course, I've just drawn that in. There's nothing to support that, but where you just got like flat to slightly upward sloping. When you get the downward slope, it's not as good a pattern for trying to manage your risk around. But it's yeah. Look, it's an interesting one, Raj, because it also could be part of like a zigzag decline, which like say you got a zigzag. But that kind of then fits with what you're suggesting as well. So like if that was as high as the rebound goes, then you get the down move. Well, then look, you could say, well, look, that was all part of that that sort of formation which you're looking at. So look, we'd need to just see that price action sort of develop probably a little bit more. But that's one of the risks. Like if a consolidation develops, how does it go? Do we get like a sideways, type thing develop over several months, and then maybe we get a rebound from that, or is it more like what you were suggesting, and we get the zigzag, or does it turn into something else altogether where you do look for that ongoing decline? So at the moment, probably not enough price action for me to really get much of a gauge on, other than to think that there's enough technical damage done to put the upward trend at least on pause for the time being.
Okay, fantastic. All right, well, let's have a look at the American market then.
So going over to the S&P 500, and this is, look, it's been encouraging to see some buying coming in off the 100-day moving average. So we had, about 3 or 4 weeks decline in the 100-day. So it's a 100-day moving average, and above that, the 50-day moving average. And we're starting to see some buying off that. I think that's, I don't think there's enough here to suggest that this ends the pullback. I think it's going to require more time, just like I was saying with the ASX 200. I think maybe we're consolidating this entire move off the low. So to give some proportionality to that, it's going to take, I think, more than 3 or 4 weeks. But it does indicate there's some interest in buying the dip, which is an encouraging sort of sign. A couple of weeks ago, we were talking about how the how price had broken below this 50-day moving average for the first time since way back here in November. So last time S&P got below the 50-day moving average was back in November. Back below here again now. So that's a bit over 5 months. Bit over 5 months of the price moving without a retest of the moving average, which is actually a really long time for this to happen. So I've seen some data on this, and just to put some perspective around this time above the 50-day moving average, this is actually the 10th longest streak since 1950 that the S&P 500 has stayed above the 50-day moving average. So just think about that, Rog. So 74 years, and the last 5 months have been some of the best ever. And so you wonder, like, what does that mean going forward? And I think a lot of people would now worry. They'd say, well, look, we've had one of the best periods ever, so the market now must be heading for like a hard down period, a big correction, maybe some sort of a crash even of the, if you've had this record run, it's got to now be paid back with a record fall. But that's not how this has played out in the past. So the way these things often work out is that strong price action leads to further gains, not necessarily straight away, but there's a tendency for the this is how trends work. The path of least resistance overall remains to the upside. Of course, you get the corrections along the way. You get trends will ultimately end at some point, but when that path of least resistance is up, we should be open to further upside, not constantly looking for things to go wrong, as is probably the case now for a lot of people. They've seen this strong period, now they're worrying about what could go wrong. Why should I be super concerned about the market? It's interesting when I look back over the data for what would happen. What happened in the past? So when we've had this big run, what's happened 6 months after the 50-day moving average has been breached? What was the market doing 6 months after that on these previous occasions? So this is a 10th strongest occasion. So what was happening in the past? And what was really interesting when I went through and looked at the data. So I had a look at the top 15. So this one's number 10. So we'll exclude this one because we can't see 6 months into the future on this. So using the other 14, the worst result 6 months out was a market which was down 12%. After that, there was one where there was a negative 9% and a negative 3%. Other than those, the other 11 were positive periods. So having a strong stretch above the 50-day moving average didn't lead to any crashes, but 11 out of 14 times led to a stronger market 6 months into the future. So results range from 1% to 23%. The middle result, or the median result was plus 7%. So who knows what this current market's going to do? Maybe this is going to be one of these ones which ends in the red in 6 months. We don't know. This isn't meant to be a roadmap going forward, and this period will have its own unique outcomes. So we need to assess and respond to the price action as it unfolds. But don't automatically think that just because the market's done really well for 5 months means that it's now got to do really poorly. Could go sideways, could be messy for several months, then it could rally again towards mid or the second half of the year, or even sooner for all we know. My take on this just at the moment, I don't think there's a hurry to do much just now. Overall, across the stock markets generally, I'm happy to play it defensively until prices stabilize, but I've still got an overall positive bias towards these markets. There's nothing to say the trend has turned down other than pausing. I think our default position should be that the overall trend remains up until we get clear evidence to the contrary, which currently just isn't there.
There's some great research there, actually, because when you tell me to think about, if it's been the 10th time doing this, I would have just said, yeah, what comes up must come down, right? But for you to say that really 6 months later, every single time on average, it's actually held by just above 5 or around 5%. That's some great research. See, you heard it here first. Fantastic. Thank you very much. It's not doesn't equal the future, right? So
I didn't go away and crunch the numbers on my own, but I'm always looking for things and looking for information, and this is one of the things I've come across, and it's interesting. This is why we should always be looking and reading and searching for information, rather than just clicking on things where someone's got a crazy headline, market's going to crash because. It's like, well, yeah, I see that all the time, but look for sensible information which actually gives you meaningful insights into the market and doesn't just hyperbole everything and look for calamity, but information which can give you confidence to maybe stay the course in your good stocks, rather than being frightened out of your good stocks unnecessarily. You always got to have risk management around your best stocks. Your best stocks ultimately, unless they get taken over or for something like that, at some point they're going to pull back and significantly. So you've got to have plans around that. But you don't want to get out of your good stocks through to fear of what might happen. You want to respond to stuff that is happening rather than jumping at shadows. At the moment, I just don't see the price action which suggests that there's something really, really big on the downsides about to happen. I don't see that.
Okay, very good. All right, well, we don't see that in the Hong Kong market at the moment. Let's have a look at what that looks like.
Yeah, well, this is hasn't this been interesting? This has been one of the movers of the week, and we spoke about the importance a couple of weeks ago. Mark was down here testing this support at around 16,300, 16,300. I was talking about like this was an important point the market needed to hold to keep the potential building bullish scenario intact, and it certainly did hold. And we've got this strong rally off that. Moving averages is now crossing. You can see this, the 1,500-day moving averages are crossing. Price is above those averages. So the building blocks of an uptrend are in place. And it's been really interesting watching this develop over the last few months. This is one of the things we've been talking about, Rog, since I think back in February we started seeing these rising lows, and then price got above some resistance. So this has been something which we've spoken about, and we've seen all the pieces continuing to come together. And so look, it's looking more and more interesting each week, really. Going over to China, and it's very much the same story. It's gone from below these moving averages to above the moving averages. Moving averages have crossed. We've got this sideways trading back towards the averages while they caught up. Now we've got another break to the top side. And for those interested in like investing in this or trading this sort of market, like looking at where it's come, it's been a long time down and out. And this may not be a final turning point either. It's just a possibility of one. And the thing is, we don't need to know whether this is it or not. We just need to know, like, if we want to get involved, how do we manage risk? And so looking at how the price action is shaping up, like someone could take a position, and you do this through an ETF, of course, around current levels on the Chinese index. And like you could just use this point from just a week or two ago, just below there, just around maybe just a touch below the 50-day moving average. That could be an exit point. So if this is actually starting to build, and you get price action, like where it just sort of like maybe pauses for a touch and it goes up again, and and so on. If you get this sort of price action building, getting a position at current levels, tight stop, it's one of those asymmetric entry points that we like looking for, where your downside is relatively low, but the upside, well, if it were to gain this, if this rally is to continue gaining traction, then you're looking at this resistance region up here around 14,700 or so. That's been a significant area. So that becomes a target point, and don't want to get ahead of ourselves by talking beyond that. It's but there's certainly upside potential, and the riskers can be kept relatively low. So they're the sort of situations that I like to look for, whether it be an individual stock or a market or whatever it may be. Doesn't mean it's going to work out, but if you play situations where your risk is relatively small compared to your possible upside, well, you probably do well over time.
Yeah, exactly. And just for those that aren't Self Wealth members, we don't have access, like Jason said, we don't have access to Chinese individual stocks, but you can certainly have, I'm sure there's an ETF out there that will track the Chinese index. We do have access to Hong Kong stocks, however, so you can trade the Hong Kong market through the Self Wealth platform. All right, now before we move on, that was a good little review of the three markets, three main markets that we sort of offer at Self Wealth. Let's just have a quick look at some questions here. Any plans there? So Graham, yes, there is a stop loss functionality on the Self Wealth platform. It's a simple stop loss functionality, so you can definitely check that out. There's no trailing stop loss, but you can certainly edit a stop loss to make it trailing. It's just a manual process, right? And we obviously are always looking at new functionality in the future. So other conditional orders is definitely potentially on the cards as well. All right. So, but it's one of those things that we do obviously continually looking at, collecting feedback from clients all the time, seeing what the priorities are, and we'll look at that going forward as well. But to answer your question, there is a stop loss that you could use similar to the way Jason teaches. It's a manual process. You have to put the stop loss in, and then you have to adjust it as it goes up and follows the price up, so to speak. Okay. And then I know if we don't want to get too far into this, because you can see some of the other episodes around this, right? But so like Jason, for instance, and I don't actually use the stop losses. That doesn't mean they don't work, because they work just fine. But it's more like an end of day process for you, I'm assuming. Isn't that right, Jason? So you would sell out of a position, you'd see it on the chart, you would just sell out of the position if it hits your stop loss on a chart. Is that right?
Yeah, I generally look at my exits at the end of the day. I'll see which stocks have fallen below their exit point, and then I'll typically sell them the next day or soon after. I think if you're trading leveraged products, something like a CFD or a futures contract, then I think it's really important to actually have a live stop loss in the market. But if you've got a portfolio of 10 or 20 or 30 or 40 or more individual stocks, and each stock has a relatively small amount of capital in it, it's not the same risk position as when you have a leverage product which is moving. So if I get a couple of percent slippage on my stop loss because I sell the next day, it's not that big a deal. And sometimes I'll get my exit and I'll go to sell the next day and it rebounds a bit and I get out at a better level. So it kind of evens itself out over time. So for me, selling the next day or soon after is fine with a large diversified portfolio of many relatively small positions. But for someone, and I know you're not doing this on the Self Wealth platform anyway, but I know people have different things set up. I don't want anyone to hear me say, oh, well, look, Jason doesn't set a live stop loss, so I don't need to worry about that with my CFDs. I think you absolutely need to very much consider using a live stop loss with a CFD if you happen to trade that, because it's leveraged. Leverage can lead to a lot of trouble if it's left unchecked. Individual stocks, well, that's another matter for you to decide based around your own situation.
Yeah, exactly. Well, derivatives are slightly different, right? So, we don't offer derivatives, but yeah, like you said, individual stocks. And plus, to manage, if you had a portfolio of 10 to 20 individual stocks on the platform, to manage those stop losses as well, it's a big job. So, I prefer just to do an end of day thing as well and just scan every morning and see, have an indicator on my charts and see if the price is closed below my trailing stop, then I'll go in and put in an order to sell pre-market open and just see what's there, right? So, but that's my system. Obviously, Jason, everyone might do something different, right? So,
it's interesting though. Some people find the stop loss is a way to enforce discipline, because they'll get the sell signal and then they'll hesitate to actually go and do what they need to do and sell the stock, and it becomes an emotional thing. And they start watching it and it falls a bit lower. They don't want to sell it, or it rebounds, and they start hoping, well, maybe if I just hold on a bit more, it'll all come good again. And they don't do what they know they need to do and follow their rules. So being able to set that stop loss for some people is a positive thing. So they'll just look at they'll get their exit email will come through their transaction sheet, and they go, oh, okay, I've sold the stock, and it de-emotionalizes the whole process for them, because they've set the stop loss when it hasn't been an issue for them, and it's been executed without them then having to go and do more thinking and place orders, and it's just done. So for some people, I think setting that stop loss is can be a positive thing if it helps dial down the emotion, because emotions are the things that really short circuit even a great process because you stop following your rules. So if it helps you remove emotion or dial it down, it's a good thing.
Yeah, and that's a very good point you bring up. But the other thing is just to remember with a stop loss in a physical market is that just because it gets triggered, if you're trading in a liquid stock, it doesn't mean you might get the full order filled, right? So it's always important if your stop loss does get triggered, you go and see what's happened with it. Has it been partially filled? Has it been fully filled? Has it been not filled, or has it been denied? Because sometimes the price may move way too far against you, and you've put in a limit or a market order, a limit order, which is too far from the last price, and the designated trade desks will deny your order because it's too far from the bid, right, or something, or the last price, right? So it is still important to monitor it and not just rely on an automated stop loss as well. All right. So this is some of the common. This is actually some of the common questions that we get at Self Wealth around stop losses, right? So I'm sort of helping out and trying to, if anyone's not aware of how they work exactly in a physical market, sometimes versus which I've traded in derivatives and CFD as well. So it's over the counter, so it's pretty much seamless. It just happens, right? It's slightly different in a physical market, right? So okay, where you own the underlying asset, obviously. All right. The other question here was just quickly, Jason. Do you use your approach for trading with ETFs? This is
the general principles. I want to buy stocks or buy ETFs that are above their moving averages, and I want to let profits run. I want to give them room to move. If they're not working out, I want to be able to close them and not hold on to them forevermore. But then also maybe with some of these ETFs, I may take like a longer term position in an ETF. Maybe it's an ASX 200 ETF, and I'm less rigid around the trailing stop losses I am with stocks which I'm actively managing or actively investing in, which they break below their moving averages or their trailing stop, and I'll cut them. So I guess with ETF, there's going to be a little bit more variability in how I manage them, but the general concept of wanting to look for things which are trending and letting profits run, very much still apply.
Okay, fantastic. All right, let's get on to our topic for now. Let's have a look at a trading market first. A ranging market. How would you identify a ranging market, Jason?
So ranging markets or sideways periods of price action, they're kind of neutral periods. So they're neither bullish or bearish. They can operate on different time frames as well. So you can get trading ranges might form if you look at a 1 hourly chart, or if you look at they might form over just a short-term range over 3 or 4 weeks. But then you could look at a range and it might last for 6 or more months or several years. So there's different degrees of ranges, and but the general principle of a range is that it's a period which is often a period of consolidation where the market may have been trending in one direction or the other, and it has a pause, and it just loses that near-term momentum and just starts tracking sideways. So I think we'll get an example. Let's get up an example and have a look. And there's a really good one recently which I've been having a look at, and it's CBA. So we just call this up. So ranges are really holding patterns is another way to look at them. And I'm just going to compress this price action up for CBA. And I've already put the blue box around it. So this goes back to July 2021, and just recently in the last few months, we've had a break out of the range. But for what's that, about 3 years thereabouts, CBA had been in this large sideways trading range. And they're pretty obvious things. I can just compress it a little bit more. You can see, like, we had a big upward move in CBA, and then this large period where prices neither rising or falling. So on any individual day, like, you look at this period through here, and the price is clearly falling. But when you put that fall into perspective of the broader price action, this is very much a sideways period. So it's falling, but it's falling within an overall range. And ranges are obvious in hindsight. You go through and go, oh, look, there's a period where the price has gone sideways. But then I guess it raises a question, like, how do you identify these a little bit earlier, rather than looking at CBA now 3 years later and saying there's a range? How do we sort of pick this up a bit earlier? And I think, like using the CBA example, and like, say you're looking at a stock on a more medium-term basis. We're not looking at what it's just done the last few weeks. You're just taking an overall view of it. Say you got some moving averages, might have a 100-day moving average or a 50-day moving average. A range forms, really. It's really when the price is just going back and forth. You can see the moving average through here. The price is just oscillating either side of the moving averages. So there's no dominant direction. And when a range might form, so if we let me just do this. I'll just sketch something up. So get a market that rallies into its high, then it falls, then it rallies back, it gets up near the previous high but doesn't go through it, and then starts to come back again. That's the makings of a potential range. So you get some anchor points. You got the anchor point from the previous high, you got the anchor point from the recent low, and now, like, what's going to happen now? So this is where the range potentially can form. So for CBA over here, we've got a high point, fell to a low point, started to rebound, doesn't get near the high till a little bit later on in this case, but you've still got that V shape. So that's the potential makings of a range. And then it's like, so at that point you can sort of like say, look, we could have some resistance at those previous highs, and now it's going to be interesting to watch this previous low, see where the price starts to hold around there. So if you get a situation where price comes back to near the low and starts to rebound again, then the range really starts to form up, and you got like a high point, a low point, and you get the trading in between. That's how you start to identify the range a little bit earlier. So let's just clear that up and come back to CBA. And so you'd look, these low points in 22, this would have been where we could have said, look, okay, let's keep watching that. That looks like a significant point around there potentially. And it's not always clear cut, because like, look what happened in this period in June 22. Prices broke to the bottom of the range, so this becomes a false break because it didn't sustain. It comes back up. So nothing in assessing a chart is going to be clear cut and work textbook every time. There's always going to be these variances. But the idea is that we can find these key areas. So we've got our high points to watch, and like, you draw along from the high point, and you can see that up around these high points is where the price could potentially fail. Down below on the low side is where it can find support, and ultimately you look for a breakout, as we got in CBA. And so these anchor points at the top are resistance, on the downside they're support. And you can also get ranges on shorter time frames as well. So just looking at this little period in here that we get, there's a really nice little range that forms. And so let's just go through and we'll assess it like we might have been seeing it in real time. So price makes a high, starts to come back. We get a low, it starts to rally again. So at the moment, there's nothing here to say there's a range. Then it gets up to this previous high and starts to pull back. So at this point, we can say, okay, we can use that as our resistance point or our anchor points on the top side. And now we've got this previous low down here. We can see whether or not that's going to hold. And you can draw that in there. So this is the makings of a range, and price trades between these two points for I think it's for at least several weeks, possibly several months, and then we start to get the breakout to the top side. That's when the range starts to break to the top side, and we get a nice run out of it. We can go back. CBA is a good example because there's a few examples of it. Something similar happens here, where we get the high point, falls to a low, rallies back near the high, comes back. We can see the makings of the range in here. In that we've got that's going to mark the top of the range, and we can be watching our low point here for the bottom of a range. Price action continues. You can see there's some low points that develop, which are higher up. So then you can say, look, maybe the range is contracting. Maybe it's a tighter range. And we start looking at levels on that lower line. Price continues to move along, starts to break to the top side above these previous highs. So you can see it's compressing. It's a bit like a spring in this case. This one, we've got a compressing range where the ranges are getting tighter, breaks to the top side, consolidates, and then off and away it runs. Then the COVID decline comes and the whole thing falls apart. So you don't always get the outcome you want, but you can manage risk really nicely around a range, and you can see when the momentum has left the share price. You can see when the momentum starts to come back into the share price. So they're really useful in terms of identifying when to get involved in the market, when to leave it alone, how you can manage risk around them, and so CBA has been a pretty good example of a range in action, which is currently playing out.
Yeah, can we have a look at BHP? Because one of the clients have asked us around BHP, and let me just read the question out basically. So how do you treat stocks that historically trade in a range? I guess you've answered that a little bit in what you just said. Example is T&E, great business, but the chart looks pretty good, but it normally gets to 17 and that's it, back down again. Good reports and progresses back up to 17. I suppose BHP is the same, from $38 to $53 historically over the years. Good businesses, but gains and losses are limited. So how would you trade BHP if you were to do that, considering that range? Let's have a look at BHP, I think.
Yeah, okay. So let's just get a chart of that. So I think a lot depends when you look at a chart and you're thinking it's in a range. A lot depends on the time frame that you're looking at it. So a lot of charting software default to 1 year, or just look at what's happened over the last year. And if you look at what BHP's done over the last year, yeah, you'd say, look, this stock doesn't do much. It gets up to around 50 and it stalls, and then it comes back down to around 41, and it seems to be bought again. And the thing is, you've got to, I think, not just look at the default time frame you get on a lot of these charting packages, but actually compress the price and look back further. Even look at it on a weekly chart and see where the prices come from. So we can say, look, this is BHP is a pretty range-bound stock from the perspective of the last year. But what about over more time? You step back, it's actually a stock which has had these really good trending periods, but we're just going through a phase now where it's going sideways, where it's consolidating. And so, yeah, it's not that BHP normally trades in a range, but it is at the moment following a strong period of trending prices. Interesting looking at the other stock, that was T&E. Have a look at that as well. And we'll probably find the same thing. So Technology One, and it's very much the same thing. So if you're looking at it on a short-term basis, so the last year or so, you look at that and go, look, this stock, Yeah, as the viewer says, gets to around $17. It's done this on several occasions, 3 occasions, gets to 17, and then starts to pull back. So it doesn't seem like there's much going after 17. But you compress the price action and you start to understand what's going on. The stock has had a strong trending period in the years prior, and now it's just consolidating. It's just working off that previous advance. And you could say, just looking at this, there's another like sideways period on this chart as well. Something thereabouts there. So your strong trending period. And this has been what? That's 2 years. 2 years of sideways price action before the trend runs, and then there's another consolidation that runs again. So it's like going up a series of steps. And the consolidations or the ranges are like the landings, where you go up the step, then you get a landing, and then you go up some more steps. Different ways you can trade ranges, which is worth talking about. One strategy for a range is that once you start to establish a range could be in place, you buy at the lower end of the range. So no, we're not going to be buying at this first point here because we don't have enough information to say a range is in place. It's really probably around from this area where I've just drawn this little line, this horizontal bar. That's probably once you've got enough information to say a range is in place. So we just go back to, like I say, that's the current. This is what we currently know about the stock. We know we've got a high point, we've got a couple of low points. It started to rally again, rejected the high again. So yeah, there's something. We've got a bit of a range which is forming up. So we've got enough information there to trade around that. So we can look to buy at the bottom end of the range if it comes down there. So it comes down to the bottom end of the range. You can buy there, put a stop loss just below the bottom of the range. You've got to give it a bit of room to move because sometimes you get these little false breaks to the downside, then it comes up. So but you can manage risk quite well around it. So you're buying at the low end, bit of a stop loss, and then as it gets up towards the top, one strategy would be to sell. You say, okay, look, every time it gets up to the top of the range, there's resistance there or there's supply. Supply comes into the market, so I want to sell somewhere up near the top. So I'm going to buy at the bottom and I'm going to sell at the top. So you might have bought some down here, might have sold out. Now you're watching again. Does it come back down? Do I get another chance? So that's how some people will trade a range. I prefer not to do that. I prefer to buy a breakout. Buying at the bottom of the range goes against my process because I'm buying something which is below the moving averages, which is moving lower. And there is a vulnerability to a market when it's doing that. So I prefer not to do that, although some people do it successfully. I'd rather buy the breakout. So I'm looking for the price to get above the range and start moving higher. Then I can buy the breakout. I can put an exit stop back within the range and then see if it runs. If it runs, great. If it doesn't, loss is relatively small. But this way I prefer because I'm going with the trend. I'm not hoping that the trend is going to, that's going to find support or find buying interest at the bottom of the range and then rebound. So I'm hoping the trend turns up, whereas our second case, it's more than I'm hoping the trend continues. So I want something that's working to continue working rather than something that's not working is going to then start to go up. So that's how I'd like to play a range. And that's the thing with ranges. Make sure you're looking at enough data, not just looking at the last 12 months, because that can lead you a little bit astray.
Yeah, it's good information there. And I think the other thing with ranges, if you're using EMAs, and which I look at a lot myself, is you can see the actual EMAs really compress versus a trending market where they're widening. As you can see, you can sort of see this play out. The EMAs are really hugging close to each other and in and out and winding until finally they start opening up again, and that might start indicating that, yep, all right, price is starting to get a bit more bullish. Maybe will it continue on and break out? We don't know that yet, obviously, but maybe it's an indicator of another trend going up or down.
Really good point, Rod. You can see, and the whole thing just flattens out. The moving averages are flat, and it's just oscillating either side of it. So now, as you say, they're expanding and they're pushing upwards again, but it's a range, so it all could turn and roll over again. So I don't like to preempt the breakout from a range. Preempting breakouts often leads to disappointment. I'd rather wait for the break to actually happen. So imagine someone's looking at the price action at this point in March, going, look, we've had this nice rally, we've come back to the moving averages, looks like it's poised to break, get a bit of upside up to that resistance point, and then disappointment, down it comes again. So I'd prefer to just play the breakout. But look, there's different ways to play it as well. I do it that way because I've tried preempting breaks in the past, and often I'm regretful that I tried to preempt it. And I go, I should have been patient and waited for the break rather than trying to get in that little bit early. But everyone will play it as they will. But don't let a market that's been range bound put you off, because often periods of inactivity and boring range-bound trading lead to periods of expansions in the daily ranges, new trends, and bullish periods. So quiet and dull leads to it's all happening. Quite often, that's how ranges work. We stop looking at markets often when they're in ranges. And people don't become aware of them again until they're made until it comes to their attention. A stock's up significantly. You go, oh, that was in a range, but look, it broke out 6 months ago and has travelled all this way. Plenty of examples of dull markets becoming really interesting. So you got to don't dismiss the stock because it's in a range. The range will end more than likely unless the stock stops trading for some reason. The range will end, and interesting times will follow. One way or the other, ranges can break to the downside as well.
Yeah, exactly. We go on a lot about trending markets, right? But I've spoken to many clients in Self Wealth that use technical analysis and trade ranges and make money out of it, right? So it can work, and it's a strategy. There's strategies out there that do it, right? So for sure. All right, let's move on to some quick questions here. It's good. I'm glad Rodney's got a great point about stop losses. Setting a bit of time aside on the weekend and setting all these stop losses for 40 stock portfolio, and that helps him, also review his trades for the rest of the week as well. So that's a good way of doing it. Let's have a look at a couple of tickers here. We'll start with gold, spot gold.
Okay, so gold's been a lot going on in gold, and I'll just find it in my long list of things that I keep an eye on. And here is gold now. So gold's one of those ones which has recently broken out of a range. 3.5 years of trading sideways, and we've got a breakout of almost a couple of months ago now. Big upward move. Just something I've been talking about in my weekly strategy videos. I cover gold each week. So the situation we have at the moment is the price has become stretched above the moving averages. My take on this is that the latecomers probably get shaken out. I think there's potential for a pullback towards the 50-day moving average, and just some consolidation of this big run we've had. I think breakouts from big ranges can lead to big moves, but there's always going to be pullbacks along the way. And you look at this previous big range that gold broke out from in it was late 2019, not dissimilar to the current range in that we had a large sideways period, had a breakout, had an initial strong move, and then look at this period which followed a little bit after. That's a 3-month consolidation. 3 months of pulling back towards the 50 and then the 100-day moving average. So that shouldn't be used as a roadmap for what's going to happen now, because now's going to have its own unique setup, but just gives you an idea that these rocket ship takeoffs, they usually don't keep going up like that. They'll more often than not run for a while, and then they'll pause and they'll take out the latecomers who bought at the high, who got excited, and then they'll steady, and then they may continue on later on. So I like the overall setup. I think it's from a medium-term perspective, I think it's looking really good. I'm holding my gold positions. I'm not trying to get too clever and sell at what I think could be an interim top, and with the aim of getting back in, because I could be wrong. Price could shoot high tonight and keep going. So I want to stay in positions, but I'm not in a hurry to add to positions just yet. I'd like to see whether we can get a little bit of a pullback, then reassess.
Okay, fantastic. One of the earlier questions was around RNU. What's your thoughts on RNU?
RNU, I don't know this one. And this is why it hasn't come to my attention, because it's been below these declining moving averages. So they never turn up in my signals. So that's why I don't see them. Looking at this one now, look, it's a stock of, it's a stock of interest. Moving averages haven't turned yet. So it's too early for me. But I can see where there's possibility here. Just looking at this, so we've gone from below the moving average to above, and now it's pulled back and it's just consolidating on the 50-day moving average. There's certainly a case that this could an uptrend could develop from here. So another move up, some consolidation, then another move up, and all of a sudden you start getting the building blocks of that upward trend with rising lows. So none of this has happened yet. It's just a sort of price action which could form from the current setup. That said, we've seen this before where the price has gone from below the averages to above. The averages haven't crossed, and then everything's continued lower again. So it's as I say, it's not for me, but for someone who's interested in this for whatever reason, look, it's certainly one to keep an eye on, and risk can probably be managed. So if somebody wanted to buy it at current levels, they could probably put a stop loss just about maybe 15% lower, just below the 100-day moving average. So that's a pretty low, a pretty cheap stop on a stock which has the potential to run a long way. So if it were to run, like just back to this previous high point of 75%, so you're risking 15%, a lot of potential upside. You're preempting strength, I think, a bit. Or the other alternative is, you buy as it breaks above. If it breaks above the this high from mid-April, so you're buying into a little bit more momentum, but then you probably need a little bit more of an exit stop. So it depends how you want to play it. So as I say, too early for me, but it's a stock of interest with options on how it could be played.
Okay, fantastic. And AIC.
Sorry, what was that one, Rob?
AIC.
AIC, is that right?
Yeah, it is a copper mine. AIC.
Oh, there it is. There, you just have to scroll a little bit for that one, and that's off and away. So this is if someone had this, if I had this, I'd certainly be holding it. I'd be using my wide trailing stop, and I'd want to see where it goes. I'd be giving it plenty of room to move, and I'd be risking giving back a good portion of my entry. If I bought on the breakout, maybe around 38 cents, my stop loss would still be around 30. My stop loss would still be back down around 38 cents. It'd be like, give this lots of room to move, and see whether it can really go, because these stocks can have tremendous upside potential when they go. Moving averages have crossed to the upside, prices racing higher. Tricky buying it now, I think, because where do you put your stop loss? Like if you put your stop loss back at the 50-day moving average, it's like, oh, look, it's 29%. It's getting, it's a bit below the 100-day moving average. You're looking at like maybe 35%. So if I was looking to get this one, I'd rather wait for some sort of a consolidation. If we get a consolidation near current levels, to get some sideways chop, and then maybe that provides a platform to get on board. It's the copper price has been running recently. The copper stock ETF that I'll look at, which is COPX, that's been running well, but it's up around some previous high points. So there's a possibility, I think, of some consolidation in the copper space. But this is an area I've been talking about in the weekly strategy videos for the last couple of months. So people have been following that, would already have positions in copper, and at this stage, like, able to let them run rather than going, look, should I buy? I think the time to buy is maybe on the next consolidation, depending on how it all plays out. But yeah, look, this stock is looking, at this point, it's looking good. I'd be letting it run.
Okay, fantastic. Thank you. Sorry, I'm having a bit of a coughing attack at the moment.
No.
Hey, let's have a look at. We'll have a look at ALU in the range. Let's have a look at ALU in a tight price range here. No, it's super tight.
Well, this one's under takeover, so I don't think there's anything to do here unless something changes with the takeover. That's my understanding. I'm pretty sure it's under takeover, so I don't think there's anything to do here.
All right, leave that one alone. It was just an example. Let's have a look at IPH and then IPX afterwards.
And the viewer's definitely right. It is a range, but it's a range for a reason, in that the takeover price is probably just above the current level. So there's no need to bid the price up, and there's underlying support because people want to buy just below the takeover level and make a small gain. So it's not a range we can do anything with. Sorry, Rog, what was that code?
IPH.
Downtrend still in play in this one, and it's been in play for a while. Moving averages haven't been positive since back here in 22. So this has been off the radar and out in the back closet for some time. And it's like, so when a stock is below its moving averages, I don't need to worry about it. I can just like push it off to the side and focus my attention on stocks which are above rising moving averages, because that's where the odds favor we get good trends from. Now, this may well develop into a nice trending stock at some stage, but it's going to take time for it to turn around. The price has to get back above the moving averages. Moving averages have to cross, and there's also the potential. Just looking at the price action here, we've got this sort of like shallow. It's not really what you call a robust bounce off the low. It's rallied and it's just sort of like chopping sideways below the moving averages. So the risk here is that we get another downward move that sees it at new lows. So it's not a stock I'd want to try and preempt the turning point with. I'd rather pay a bit more and get in later, could be around $7. So I'd forego maybe 70 cents. And if it were to base round here, and bases can meander sideways for months as well. So it's not like it needs to do a V-shaped recovery. If it were close to bottoming, it could just chug sideways for months and months and then get above the averages. The averages turn. By now, we could be out towards the back end of the year, and there could be time. And I think there is time. There's time to watch this one and just see how it develops.
Okay, fantastic. IPX.
It's an interesting one.
Ranging there, small
range. So we've very much got that range, don't we? We've got the two highs and we've got a low. So there are our anchor points that we spoke about earlier, and now we're just coming back down towards the bottom of the range. So you've got this clear ranging formation there, coming back towards rising moving averages, not dissimilar to what we got back in this period in around November last year. Does it play out the same way? So it's up at all-time highs, and that puts a lot of people off. They go, oh, well, the stock's at all-time highs, it's due for a fall. But stocks at all-time highs, they're there for a reason, and often they'll make new all-time highs. All-time highs tend to follow all-time highs. until some point where it doesn't, but who knows where that is. That could be many months or many months into the future. So ways to play this, it could be bought. Buy the dip. If someone wants to buy the dip, this is where I'd be thinking about buying a dip. I'll pull back to rising moving averages. Stop loss would be just back below the 100-day moving average. So that's maybe one strategy would be maybe giving it about 15%. So back below the 100-day and a bit of a margin, because as you can see, you can dip below the moving average and come back up. So the moving average isn't like, is a set line that the market can't cross. You can get an excursion beneath it and then back above. So I'd give a little bit of room to move. So that's one play. The other play would be buying a breakout above these resistance points. So maybe that's going to be about $2.50, $2.49, $2.51, something like that. Buy a breakout and then let that run. Manage risk around that. If I had it, I'd certainly keep holding it. It could also form a topping pattern here and then break down. So it's not guaranteed to go up, but if you want to play it from the long side, they're the strategies I'd be looking at for doing that. If it broke down to the, if we got a breakdown beneath the range, and then you get a shallow rally where it then just stalls, and the moving averages then start to roll over, come out, roll over the top of the price action. So you get the price action below the averages. That's when you get worried about the break to the downside. But that's a little way off before we get to that possibility. So you can see how the possibilities can play out on either side, and you're just managing the risk around either one, and you're placing your exit stop so you don't get caught up in a possible unraveling. You don't want to be involved if that's going on, but if it is to break to the top side, well, then you want to hold your positions, let them run, and maybe add or enter.
Okay. I think we'll finish off on AHX. Okay.
And I was talking about this in the weekly strategy session on Friday. It's it's an interesting stock from below the averages to above. We've had the compression, sideways compression back to the averages. Averages have crossed, broken to a new high. This is a stock which has potential to continue rising. I like the risk reward around it. Like it's had a long period in the doldrums where you wouldn't have wanted to be involved when it's below these declining moving averages, but that's possibly changing. So it could continue to rally from here. It could also just stall here and then just bounce along the bottom for months and months. So this is why we use the risk management. So the play here would be, well, it could be bought at current levels and exit stop just below the probably below the 100-day moving average. Probably looking at maybe 16-17% of risk and possible upside. Well, it's a big multiple of that. So it's an asymmetric play. Asymmetric plays don't guarantee success, but you play enough asymmetric setups where the setup looks to be positioned in your favor, you're probably going to do pretty well over time.
Yeah, I like that one. And we will finish off now on LYC. This will be the last one.
Okay, LYC. Linus, and this is one I've spoken about recently as well. Potential touch early for me, but it's potential turnaround. What I really like about this is you can see this support, which was in place around $6.08. So price broke below support, consolidated beneath it, had the declining moving averages, tried to break to the downside. And this is when it was most vulnerable, really, from this position here, like what you would have been seeing at the time. So we would have been seeing this at the time. Had someone said, look, what do you think of Linus at this point? And this was only in this was a month ago. What do you think of Linus? I would have said, look, stand clear. This is in a highly vulnerable position. This could really start to unravel to the downside due to those factors we just went through. But instead, there was no follow-through selling, and the price has broken back up above this previous support, which became resistance, and has now cycled from below the averages to above. So this is the potential makings of a turnaround. Averages are now starting to turn to the upside. I think this is a really interesting play. Like, this stock could be bought at current levels and you could have a stop loss just below that previous low. So that's around 17%. So if it wasn't able to fall apart when it was really on its knees, I think that's an excellent point to put an exit, a stop loss. So 17% of downside, upside is significantly greater. It's for me, it's look. I'll wait for the averages to cross and for it to break to a new high again. So just some added confirmation. But for someone who wants to be a little bit earlier, this is. I think this one's in play now, and risk can be managed around it really nicely, I think. So I like the upside potential. I like where the risk can be managed. I like the setup. I like the failed breakdown. It's a really interesting stock.
That's fantastic. What a great opportunity to finish off on. Thank you, everyone, for attending. Thank you for your interaction and your questions. Next week, we'll have a general Ask the Experts session. So if you do have any questions, you can either put them on the YouTube channel here, which I'll monitor, obviously, or send it into our support. Any questions at all, please let us know. Please like and subscribe as you normally would, as well as visit Jason over at Motion Trader, whether it's on his videos or on motiontrader.com.au. I'm from selfwealth.com.au. Check out our lovely new website. It's actually, things are getting faster as well, right? So it's not just on the website, but also the trading platform. It's become a lot faster. We're actually developing a lot of great technology over at Self Wealth as well, right? So, okay, so that said, thanks, Jace. Much appreciated.
Yeah, that's been fun. Rog. It's been good going through all those charts and the viewer suggestions. Some really interesting things there as well. So, look, thank you everyone for joining us.
Beautiful, and we'll see everyone next week. Take care, everyone. Bye-bye.